Welcome back to the Money Mindset Mastery Podcast. Today, we're thrilled to announce a powerful new referral partnership that will redefine financial planning for business owners and incorporated professionals. Stay tuned as we dive into the details with special guests from Canadian Benefits Associates and get expert insights on individual pension plans and retirement compensation arrangements. This is an episode you won't want to miss.
Love that song. Pretty catchy. How's everybody doing? I'd like to welcome everyone to the Money Mindset Mastery Podcast. I'm your host, Jim, and joining me as always is my co-host, Ryan Genoe. Ryan, how are things today?
Good. There's so many faces on the screen right now. I don't know what to do or who to stare at right now. So it'll be interesting to have this conversation today because, again, today is about education and introducing something admittedly I didn't know much about up until really like 3 or 4 months ago. But it's very interesting and how it can help a number of clients out there and specific to what their needs are. So yeah, I'm here to learn mostly. And again, the face of the podcast.
Yeah, it kind of looks like the Brady Bunch intro, right? It's we're missing one more, I think. So next time we'll add a third one or a sixth one, actually. So today's topic is maximizing your retirement, exploring IPPs and RCAs, and we have 3 special guests joining us today. First, from Canadian Benefit Associates, we have Clark Steffy, Director of Actuarial and Consulting Services. Clark, welcome.
Thank you. Glad to be here.
Yeah, thank you very much. And we also have Muneer Feeroze, Managing Partner. Muneer, welcome.
Great. Thank you, Jim.
And then also joining us, we have Mike Lee, CPA, founder of Exponent CPA Professional Corporation. Mike, thanks for joining us today.
Thanks, Jim. Happy to be here.
Yeah, so again, we're going to keep this fairly casual. What I will say is we are live streaming right now on multiple platforms. So if you happen to be on your lunch hour right now and you're watching and we catch your attention and you happen to have some questions, as long as the social media platform that this is streaming on live offers the ability to send a comment in, you can go ahead. We'll pick it up on our end. And if we're able to, we'll definitely be able to share your comment or any of your questions. So that's just on the side. But the first thing we're going to say, Ryan, is we're really doing this today because we've recently partnered up in a referral arrangement with Canadian Benefits Associates for them to come in and offer actuarial and consulting services to our business owners and professional corporate owners as well. So that's a recent offering, and we feel that there's definitely a need for the expertise that both Clark, Muneer, and Mike offer as well to our clients. So why don't we start off a little bit with the background of Canadian Benefits Associates, and I'm going to open it up to anyone who wants to kind of step in and take over from here.
Okay. Well, thanks, Jim. Why don't I sort of start off and just give you a little bit of a background. Canadian Benefits Association, or Associates, was started up about 15 years ago. The principals within Canadian Benefits Associates have combined experience of over 150 years. We are a boutique actuarial shop, which basically means, we do a lot of IPP RCAs, but extending from the IPP RCAs, we also do a lot of just regular DB, post-employment plans, SERPs, etc. A little bit about my background. I've been in the industry for over 35 years now. Clark and I have been working together probably at least for the last 20 years.
Yeah, and I go back with Clark probably about the same time as well. So we have a long-standing relationship. And Clark, when did you officially join Canadian Benefits Associates?
Well, that's a great question. I officially joined on January 2nd of this year, but Muneer, I've been referring advisors to Muneer and his firm that I just friends from the industry, being in the pension field for the last 30 plus years. They always came to me saying, who should I call about an individual pension plan or a retirement compensation arrangement or anything complex in the pension field? Sometimes it's been a governance question, sometimes it's just a technical question. And Muneer, out of maybe he confuses work and fun, but he just has gone over the top trying to help me and my clients, even though, they weren't even a client of his. And we just grew and grew and grew. And then on January 2nd, I said, well, let's make this official. We've been working together for 20 years anyways on an informal basis. So yeah, that's how it all happened. And we met Mike, I think it was in November of December, and he's a specialist. It's not, I don't know of any other IPP RCA accountant specialists or tax specialists, and he's already sent us 12 IPP RCA clients year to date. So he's really embraces the solution and knows how to help the client save money in taxes with it. And what we find is many accountants have some experience with the IPP RCA, but they're not expert in it.
Thanks. I'll pay you some money.
Just excuse me, guys. I lost my headphones, so I can't hear anything right now.
Okay.
So Ryan, maybe you can kind of step in. Technical glitches all of a sudden.
Yeah. So again, we mentioned it very quickly. Individual pension plans, so IPPs, and retirement compensation agreements, RCAs. I think as we talk about through this about what and how is most important and what is the value that it adds to clients. Again, we wanted to take this at a high level and allow people to ask questions down the road, especially if it's something that sparks their interest. But what is the value and importance of starting some of these things like an individual pension plan, IPP, or retirement compensation agreement?
Let me give a try at that, guys, and then we'll let Muneer and Mike kick in. So there's been a lot of changes in the tax rules and pension rules that have really kicked this off. It's been around. The current rules have been around since 1991. The solution itself's been around longer than that, as has the RCA. So it's nothing new, but there are a lot of new things. First of all, pension regulation was removed for IPPs, for business owners in Ontario on December 8th, 2020. So that was a turning point where it just became much more flexible. All contributions are optional, and the assets no longer have to be locked in upon wind up. So that changed everything, because prior to that date, a lot of clients would say, well, this looks great as a tax sheltering tool and I can tax deduct the money, but it looks like a big commitment. I've got $1 million of past service, for example, I could buy, and, contributions double what the RSP limits allow almost. That looks like a big commitment. I might want to buy a cottage or a boat. Yeah. So they felt trapped almost straitjacketed by this solution, even though it wasn't quite that severe. But I think it clarified the issue by removing pension regulation for connected business owners. And I'll just emphasize that a connected business owner is somebody who owns 10% of the business or more, and their direct family members who are working in the business are also classified as connected business owners. For them, pension regulation does not apply. So this is a very flexible structure for them. Now, if you were to do this for a regular employee, pension regulation would apply, and you lose a lot of that flexibility. So we got to be very careful that when we're positioning the IPP and RCA, we're talking about connected business owners generally, because they have a lot more flexibility around it. And then I'll save it for Mike and Muneer. There were a lot of tax changes that made it much more favorable for business owners than in the past. And maybe I'll pass the ball there to either Mike or Muneer to talk about the passive income rules and other.
Before we get into that, sorry, because I lost sound, did we ask what is an IPP and an RCA? Has that been kind of shared with everyone?
Not yet.
Yeah.
Maybe that would be a good place to start.
Yeah, so let's maybe not get too technical as of yet. So, Mike, would you like to take that one? What is an IPP and an RCA?
So IPP and RCA, they're basically what we call a registered account. There's no difference than RSP or any other pension. So registered account meaning you register with the CRA, right? But there's a huge difference. The difference is that IPP and RCA are their corporate sponsor, meaning only the corporate dollar, pre-tax dollar, you can make contribution to IPP and RCA with a corporate pre-tax dollar. And that creates a huge benefit because every dollar contribution that you make is a deduction against the corporate profit. So that's a very big difference. The other one is that with RRSP, they're called a DC, or defined contribution. Basically, it determines how much dollar you can put in. But IPP and RCA, they're basically DB, defined benefit plan, meaning that it calculates how much you can pull out once you retire. So that's a huge difference. And because of that DC and DB difference, the amount of money that you can put in the IPP or RCA is usually way larger than the DB, defined contribution plan or RSP plan.
Muneer, why would someone choose RCA over an IPP, or can you do a combination of both? So maybe you might want to explain the differences and why one would be suitable over the other.
Sure. With regards to an individual pension plan, similar to an RSP, there's a dollar cap. So in an RSP this year, we'd be looking at like a $31,000 and change dollar cap. Whether you're making, $200,000 or $400,000, there's a dollar cap. So similar with an IPP, there's a cap. So the maximum benefit that you can earn under an IPP is based on a salary in 2024 of $180,500. So if somebody has a T4 of $200,000 or $400,000 in an IPP, they would have the same contributions, assuming they're the same age, would have the same tax deductible contributions that somebody 200 or 400 is making. So it'd be the same contribution. What an RCA does is it normally sits on top of the IPP and removes that dollar limit. So everybody would be making, so that individual who has a $200,000 T4 income versus the 400 would make the same contributions to the IPP, but would have significantly higher contributions. The $400,000 individual would have significantly higher tax deductible contributions made on his behalf to the RCA than the one with 200. So basically, it brings in equity, right? So if you're making a higher salary and you are targeting a specific retirement income, instead of putting on it, it allows you to contribute up to your salary level, and it brings in pay equity or retirement equity.
I've worked with corporate owners in the past, and many of them who have not heard of an IPP or an RCA, what they tend to do with their accountant's recommendation is just pull the money out of the corporation, pay themselves, and then put the money into an RSP to offset the tax income, right? With the IPP, it actually provides the deduction, or it's a business expense to the corporation as well. So,
correct.
Mike, can you maybe discuss or get into that a little bit more? The benefit
Sure.
from doing it that way?
Yeah. Dividend is really a very common way to compensate business owners, but that has changed since 2015, where they introduced this TOSI, right? Before being one of the benefits and being a small business owner, that you can, what we called sprinkle the dividends, basically paying a small amount of dividends to family members. They also allow for any shareholders that's more than 18-year-old. That was allowed. But right now they put more restrictions on the dividend sprinkling conditions. It makes it way difficult to spread income, reduce the taxes as a whole, as a family unit. So we had before 2023, we had more tools. Basically, we can withdraw a larger amount of money at a lower, more favorable rate. But that changed as well after 2023. So right now, we don't have too much tools left. And especially after 2022, December, they removed the restriction that Clark just mentioned. A IPP and RCA or corporate pensions becomes the only benefit or the only tool that we can not only reduce the amount of income within the corporation, but also can have a large withdrawal or retained earning extraction that become available to the business. Because all these changes since 2015, the IPP and RCA becomes more and more popular. Not many people are implementing this. It's been there forever. It's just because of the trend in our tax system has changed.
So it's a deduction to the corporation. Is this a way of mitigating some of the capital gains tax now with the new inclusion rate? Is there a benefit there in setting up an IPP and RCA, or not so much?
They could, okay. Because when we talk about the inclusion rate, that's a 2/3, and this inclusion rate will apply on death. Basically, for any Canadian tax business owner, on death there's a deemed disposition, meaning that the deemed disposition will apply to all assets, including the shares of the corporation and fair market value. So before it's 50% inclusion, now it's 2/3. So that will bump up your the tax liability on that. But because we can reduce the amount of the asset by putting cash or close to cash items into a pension, that will remove some of the liabilities on that. So this is a really good way to reduce that. Also, so let's just say if you have a holding company or operating company that sells or sold some asset has a huge spike in terms of capital gain, and RCA IPP can be a very flexible tools to reduce that gain because of the deduction that becomes available.
Okay. And Clark, would you say that either one of these tools is a great tool for those business owners that are looking to put in place a succession plan for their businesses to their children, for example?
Yeah, one of the best kept secrets of the IPP and RCA is the intergenerational wealth transfer. And so the assets can transfer tax-free to the children. You can't do that in an RSP. As long as the children are working in the business and earning a T4, you can put them on the plan, and then upon the parent's death, the assets remain in the plan for the children. Now, the children need enough service to be able to capitalize on that and not pay tax on it. But if for family-owned businesses, this is something that's a great advantage. But it can also work the opposite way. If, let's say, the parents live to, I'm going to use a crazy number, 120, with artificial intelligence and medical advances, who knows how long people are going to be living, but we have a lot of longevity in our family, so it's a common topic. Let's say they live to 100. There is a chance that in this plan, the kids can keep working in the business, keep getting a tax deduction for the parents, and or for the by making the contributions, keep getting a tax deduction for the company and contributing to the parents' pension. So it's a longevity protection as well as a life insurance protection. So you got to think of it both ways. And so for business owners, family business owners, this is a really key tool to look into.
Awesome. And then Muneer, I guess my question for you would be would either one of these tools be appropriate if a business owner was looking to eventually sell their business? So maybe you can talk about that a little bit.
Sure. I mean, it can work very, very effectively. So if a business owner, just to go back to Mike's point, where when a business owner sells shares, the value, they may get a capital gains, a significant capital gains coming into the corporation. So if you do have an IPP and RCA, you have the ability of taking some of those capital gains through the shares and contributing it to the IPP RCA. Now, this all means that you have the room and the ability to do it. So one of the caveats I will put on it, the IPP RCAs is not an unlimited bank where you can put whatever dollar amount you want to. It is based on a calculation, based on the T4 income the individual's been taking, their ages, and how many years of service they've had in the past. But if that room does exist, then absolutely, there is an opportunity there to take advantage of it. Another opportunity is when you do set up an IPP and or an RCA. Basically what you're doing is you're making a promise to that employee of that corporation that you're providing a benefit. As soon as you make that promise, that creates a commitment on the company to provide that benefit. That's a liability. That in itself, whether you fund it or you don't fund it, i.e., whether you transfer the money into the IPP immediately out of the corporation, or you say, well, I'm not going to put the money in yet, but I will in future years, it will have an impact on the value of that company, because all of a sudden now you've got a liability that hasn't been paid off, and it goes down to the liability side of the balance sheet, lowering the value of the company, i.e., lower capital gains.
So let me just
Sure.
so basically there correct me if I'm wrong here. So can we have two sponsors, for example, a holding company and an operating company, to sponsor the same pension plan? Let's just say if the business owner sells the operating company down the road, 10 years down the road, then I still have my pension asset in that it becomes affordable. So that as long as I have a holding company that stick with me, and that pension asset is still gonna be there, and I'm not selling any asset with the corporation shares. That's correct.
That's correct. So normally, with a pension plan, you can have multiple companies participate in. So Mike's correct. So you can have so if the member is receiving T4 income from, say, the OpCo and a little bit from the HoldCo, then both of those companies can make contributions towards the IPP. And then down the road, as Mike said, if you sell the OpCo, the HoldCo is still around. So there's a quick amendment to the pension plan saying we're dropping the OpCo as a, quote, participating employer. But the IPP can continue at the HoldCo level. So you don't have the situation of, well, if I'm selling the OpCo and I was receiving some income from the OpCo, do I have to wind it up? No, as long as there's a sponsoring corporate entity, and usually for most business owners, they will have a HoldCo that will continue, then the IPP can continue at the HoldCo level.
So I will ask this question for any one of you three, or all three of you could potentially answer this one, but any real life examples that you can share, understanding we don't have any visuals right now, so we're going to discuss it. But I'd open up to the three of you, any examples that you can share with us.
Yeah, there's many examples. Let's say in the sales situation, that was really good, because I had a client where recently they're being approached by a potential buyer to purchase this company. Let's just say for $2 million. This client of mine is the sole shareholder, so his lifetime capital gain exemption, meaning when he sells the shares of the company, well, it really depends on if the budget going to pass. Let's just use $1 million to be a assumption. So he's only got $1 million exemption for the disposition for the capital gain of the shares. So he's still got say another $1 million where they cannot shelter because he doesn't have enough room for capital gain exemption to shelter that gain. So what do? We could potentially suggest the buyer to say, why don't you pay the seller $1 million for the shares and commit another $1 million to contribute the pension of that corporation. So this proposal was well received, I should say, and we're able to save the client significant dollars on the transaction. That's one example. Continue back to Muneer's example, where if you have set up this pension as a commitment, also a liability to the corporation. A lot of estate freeze situation where the original or the first generation business owner, they're converting their common shares or value increase shares to fixed value preferred shares. And that can reduce the value of that on the conversion, which eventually would help the first generation business owner to save tax on death, and also will increase the value of the new shareholder or new common shareholder, which usually are family trusts or the children of the family or of the business. That's another situation. We have more situations like, say, for example, departure tax. And that's also very cash flow wise, very detrimental to someone who wants to leave Canada and owns shares of private corporations in Canada, right? So we can set up this type of structure where that would significantly reduce the amount of the tax on leaving Canada. And that's another example.
I can probably jump in and give you one of the advantages. So when you set up an IPP RCA, depending on the services and the T4 income you have, the tax deductible contributions could be significant. So in another circumstances, what happened was the corporation had significant assets invested through the corporation, retained earnings, investable cash. So we set up the IPPRC scenario. They then took the cash that they had in the corporation and invested it into the IPP/RCA. Now, in this case, I'm just going to use different numbers, but the concept is the same. They say popped in $2 million into the IPP/RCA combo. That gives them an immediate tax deduction. So if the net income for that corporation that year would have been $500,000 and they would have paid taxes on the $500,000, what now happens is that corporation has a loss of $1.5 million because their net income would have been $500,000. Now they've got an expense for $2 million. They now have a loss of 1.5. So for that year, the corporation pays zero taxes, but that $1.5 million of loss can be carried back 3 years and any taxes paid reclaimed, i.e. they can take those losses back and reclaim them, or forward 20 years. Now in this situation, I believe the client went back and reclaimed some of the taxes that had already been paid. So this is another example of where there is a potential. Mike, correct me if I'm wrong with this 3 and 20 years forward.
3 years, yeah.
3 years back and 20 years forward, the ability to go back. So if you do have a prospect who has had a really good year last year and paid a lot of taxes, now they do have the ability of potentially being able to recover some of the taxes already paid. Now, one of the side advantages of this IP that we haven't talked about is when you're looking at the IPP-RCA structure, there is a concept of passive income rules. So anytime when you have realized income based on passive assets, so you've got retained earnings in the corporation, you're investing it in the stock market, it realizes income. Once it's over $50,000 that year and going all the way up to 150, the active tax rate starts increasing from 12.2%. This is for Ontario, but for other provinces, slightly different. And it starts increasing until by the time you hit 150, you'll lose that small business tax advantage. So one of the other advantages with an IPP-RCA is in this situation, when you're moving $2 million out of the corporation and putting into an IPP-RCA, guess what? That $2 million no longer generates realized income inside the corp. So there's a potential that you may now be paying lower taxes, depending on your situation, on your active income. So that's a side benefit of making that contribution on top of the tax deductions.
It's really good
that's amazing.
healthcare professionals.
Yeah.
Okay. Primarily healthcare professionals, or would you say lawyers who have professional corps as well? So any professional corp?
Yeah, any professional corp.
Okay. So let's talk about that in terms of qualifying or being able to set up an IPP and RCA. I mean, you can't be someone who just establishes a corporation tomorrow and set this up. Like there are certain rules that have to be followed. So can you maybe share some of those so that way, new business owners aren't calling us saying, I want to do this. It sounds fantastic. And saying, sorry, we can't. So whoever wants to take that, go ahead.
Well, let me start off with it, and then I'll pass it on. Normally, the rules of setting up an IPP-RCA is you need T4 income and incorporation. To answer your question, if I were to set up a corporation, say September 1, and wanted to set up an IPP, yes, I could. It's just that I wouldn't have any past service. So the only thing I would be doing is putting it from September 1 onwards. But to give you an example, in an RSP, the maximum contribution you can put in is 18%. Okay. With regards to an IPP, depending on your age, that contribution rate could be 23% or 24%, all the way up to 29% when you're getting close to 65. So just that difference between if you're starting from September 1, for every dollar of T4, you can now put in 25% versus 18% is giving you 7% extra contribution. All it does is it doesn't give you the ability of past service, which could be, for people with long past service, could be hundreds of thousands of dollars.
Okay, so someone who does start a corporation draws T4, significant amount of T4, can set up an IPP and make the contribution to the IPP. That's
Immediately.
great. Yeah. Okay, so that's good news. Anything else you guys want to add to it, Clark or Mike?
I think the only thing is the timing of the setting of this IPP or RCA. So in order to qualify for deductions, the contribution, IPP and RCA are slightly different. For IPPs, you have 120 days after the year. But it takes time to get IPP approved from the CRA. So you have to bear that in mind. The other thing is RCA. RCA is the contribution has to be made prior to the year. So let's just say if you have November year, for example, and that plan has to be set up. And when we go through of all this IPP or RCA setup, we also have to talk to your financial advisor. It depends on which bank. Each bank will have different process in time. Let's just say some are better, some are not so good. So you have to take that into consideration as well. You cannot just wait until Friday, you say, I want to set up this thing in 2 weeks. Usually I think it's still doable, but it's really, really put a lot of pressure.
Well, let's speak about that because it sounds potentially complicated. There's a lot of moving parts to these structures. So there's really a team of people involved with setting up an IPP RCA structure. So the first one is, we'll talk about Canadian Benefit Associates. What's your role specifically?
Okay, so, great question. Our role, in essence, so when you go to the bank and you open up an RSP account, what you'll find is the bank will have a document about 300 pages. They'll say sign here initially or sign here initially, and you go through that document. In an IPP RCA, that plan is being created for your corporation. So those documents have to be prepared to sort of have them set up with the regulatory authorities. That's CBA's role. That's our role, to prepare those documents. So when an IPP is set up, you will get about 200 to 300 pages of documents to sign. But the complete preparation of those documents is the responsibility of CBA. So with regards to the other parties, the investment advisor, the accountant, and the member themselves, the member's responsibility will be to sign a lot of those documents and sort of say, go ahead and set it up. The advisor's responsibility is basically opening up the IPP account, right? So we need the account opening application. And the accountant is basically the financial guru who's going to go and say, look, here's the numbers. Yes, it makes sense. And when to contribute. So that paperwork and that filing is all our responsibility. Once it's been filed, I usually joke with our clients that, it takes them about 15 minutes a year to actually do the regulatory filings. Most clients will come back to me and say, well, it's a couple of minutes because we just signed the documents you sent. So regulatorily, there's a couple of documents that you have to sign each year, which is, again, part of our service offering where we prepare them. And and one of the individuals who's responsible for signing will execute them. And then we file them with the regulators. Now,
and there's clearly a cost associated with that. We won't get into the cost at this point, but whatever costs there are in terms of setting up the IPPs and RCAs, that's a tax deduction to the corporation as well.
Absolutely, 100%. So our fees are fully tax deductible to the corporation. Now, they can be paid from the pension fund, but most of our clients elect to pay it out of the corp because they are fully tax deductible.
And then there's obviously a big role from the accountant's point of view. So, Mike, you've been doing this for a while now. What is the role of the accountant, and maybe what is your role in supporting some of those accountants? Because I can speak to TVH Accounting, David, who you've all met. He does his accounting. That's what he's really good at. But he definitely appreciates the support that you provide him to be able to kind of identify these opportunities. So maybe you can speak to the role of the accountant, both yours and other accountants that might be listening right now.
Okay. For my own clients, is basically knowing your clients, right? You know their family, you know their what kind of cash flow they're looking at, you know how, if they have a windfall profit this year in terms of their operation, or if they sell an asset, there's a huge capital gain. From that point, I can basically make a recommendation. Hey, here are my tools. We can potentially looking at implement them to see if that's going to save you a couple dollars in taxation. That's usually how the conversation starts. And also from financial advisor's point is that, what's my retirement going to be, right? 20 years down the road, I want to have this kind of lifestyle. Do I have enough cash flow to do it? And how do I do it? And how is the important part is that you want to do this with the most tax efficient. So IPP RCA is definitely the best tools available. And from other external accountants, we typically get into estate planning, setting up a family trust or holdco, and looking at potentially selling the business 1 year, 2 years down the road. The other benefit I think we forgot to mention is that RCA and IPP is that when you sell a business, we have to make sure the business itself is what we call pure. What does it mean? It's like when you sell a business, we have to take a look at your balance sheet and see, okay, if there's any bad, meaning cash or stock portfolios or rental properties are sitting on your balance sheet that you don't use for the business. So we call it passive assets. So these assets are bad because if you go over 10% right before the sales of the business, you won't get that 1 million or 1.25 million of capital gain exemption. So one of the methods is that to have all these assets put in the pension plan. So off the balance sheet, right? So before you sell the business. So I think overall my role is when it comes to external accountants is that I can come in and say, I can do some plannings, whether this is estate freeze or purification or setting a family trust and multiply the capital gain exemption, etc. And that's where I come in. And IPP and RCA usually a product that I can also bring on board and to say, on top of everything else, this is a really good tool for you to have for retirement.
That's great. And I think from an advisor point of view, and we can speak to that, the first thing I want people to really be clear on and understand is we are all separate businesses. So if you are a financial advisor listening right now or an accountant, and you think that you might have some opportunities for Clark, Muneer, and even Mike, then I would suggest you reach out to them directly. If you are a business owner and you're trying to determine if this is appropriate for you, I'd invite you to reach out to both Ryan and I as wealth advisors, and then we can connect you because we also have a team in-house of legal. So if we need to establish certain things, certain documentation, we can do that all in-house with the guidance, obviously, of Mike, Muneer, and Clark. And then from an investment point of view, we also have TVH Wealth. So if you're looking for someone to manage those IPP RCA assets, that's something that we can also offer in-house through our portfolio manager, Denis, at TVH Wealth. The big question is, and this has come up in the past, so if we identify that this is appropriate for a business owner and we're setting up an IPP RCA, we might have to basically fund that IPP RCA by way of transferring RSP assets, correct? So why does that have to be done? And is it something that is a choice or an option, or it's not a choice or an option? It has to be done.
So the question there is, it depends. If you when you set up an IPP, you do have now first of all, there's no transfer in on the RCA side, right? This is exclusively on the IPP side. When you set up an IPP and you're saying, I would like to go back. I've been working with the company for 10 years and I'd like to set up past service and contribute for it. What CRA does not want you to do is double dip. So if you've been fully contributing to your RSP, now you're going back and setting up an IPP and also and getting a tax deduction for the same period of time. So they have this rule, and it's not a simple calculation. It brings in various items based on your T4 income in the past and the market value of your RSP assets. But in a nutshell, you get a number, and that value is the amount that CRA will say is what you have to transfer from your RSP into the IPP for you to be allowed to be buying the past service. Now, that transfer is what we call a qualified transfer, which means it's not taxable to you. It's just transfer from one registered plan to another. But usually the way the numbers work is, so if we're creating a past service, I'm just going to use some round numbers here. The qualifying transfer may be $250,000. But the value of that past service benefit you've set up could be $400,000. What that means is your RSP would transfer the 250, but that 150 additional contribution now becomes a tax deductible contribution for the corporation. And the corporation can make that contribution get a full tax deduction. But if you elect with 10 years of service that you don't want to do any past service contribution, or you don't want to have any past service and you just want to move forward, then there's no qualifying transfer. One other caveat: if you have been running, you've been working in the company, what some business owners do, and they have no RSP assets or very little, but they have a lot of RSP contribution room. So before that qualifying transfer is calculated, we can use all of your RSP contribution room to provide that past service. So that's the first thing we would do. We do the calculation. We say, do you have RSP contribution room? Yes, we'll use that up. If there's any additional amount we need, then we go and say, okay, this is the X dollars you have to transfer from your RSP into the IP.
Okay. So I'm going to speak to right now to business owners who might be listening or watching. If you have an advisor or an accountant who hasn't brought this to your attention, I would say reach out to us. Obviously, we put together a strong team here to help you. Now, does it mean you have to fire your accountant? No. Does it mean you have to fire your advisor? Not necessarily. So we're not asking you to, stop those relationships. But I would suggest that at the very least, reach out to us. And when I say us, I'm referring to Ryan and I at TVH. And we can determine again if this is appropriate for you, and then we can connect you with the right people, obviously. So we're going to probably start to wind things down a little bit here. Any last comments, Clark, at this point that you want to make, Mike or Muneer?
Well, I think you make a really good point, Jim, that if your financial advisor or accountants haven't brought this to your attention, it's probably because they're not familiar with it or uncomfortable with the solution. So hats off to TVH for digging into a topic that's a bit technical but has tremendous advantage for your business owner clients. Perhaps the other thing is, if you're not a business owner, you do have to worry about another layer of regulation, but these can be very useful for senior executives. Obviously, your company, the senior executive's company, has to have buy-in to do it for you, but it can be a very useful tool for senior executives that have a tax problem because they're earning too much money. Maybe a nice problem to have, but these can be very useful for severance situations as well as retention and attraction of key executives. But for the most part, these solutions are used for business owners because they're much more flexible for business owners.
Mike, any final thoughts or comments on your end? And if not, it's okay.
Yeah, I'm good. Thanks.
You're good. And Muneer?
You know what? I'll just close it off by tying in the three main entities in it. Us as the actuarial firm, Mike as the accountant, and yourself as the investment advisors, is when we're setting up an IPP RCA, we would think of ourselves as the old what, when, and how. So we are the entities that will calculate, what amount you can contribute. The accountant's going to tell you when to pop it in, take advantage of the tax deduction, tax deductibility, and the advisors will tell you how to invest the money. So, and those are the three different roles when you're running an IPP RCA.
Awesome. Well, I'd like to thank everyone. Ryan, can you maybe share with everyone how they can find us and what they should do in terms of clicking stuff and all that other wonderful things that we do at the end of an episode?
Pop quizzing me now.
Yeah.
I thought I'd just close with saying, for business owners out there, if you don't want to make your business more valuable and you don't want to, save for your future, then, don't do this. But if you want to make those steps to make the value of your business better for yourselves generationally too, perhaps if you like saving some tax along the way too for your business and at the end, well then give us a call. So, tvhfinancial.ca is our website. Our phone number is the one that I always forget because I don't call ourselves. So Jim, sorry about that.
647-727-4668.
That's how you can reach us. So
yeah. And if you're watching this on a social media platform, we encourage you to subscribe, share, click, do all those wonderful things. And until next time, we will see everyone soon. Thanks again for your time today.
Thank you.
Why is it me? Why am I a guy? I still buy low, still sell